Give folks just a minute to join. Hello and welcome, everyone. My name is Ben Jackson. I'm the Chief Operating Officer of the Innovative Payments Association. Thank you all for joining us today. I am excited about today's session. We are once again joined by Corey Besaw, the Chief Operating Officer of Ubiquity, and he's going to talk about tax refund fraud and dispute trends. And what makes me glad that you're all able to join us today is we did a session with Corey, gosh, maybe a year ago, maybe a year and a half ago, and we talked a little bit about some of the ins and outs around disputes and fraud management and some of the ways in which companies can use the tools of customer service and dispute processes to mitigate some of the problems that come up. And I will say that ever since that webinar, I have referred people back to it. I have continually said, you need to listen to this past webinar. And so today, we are lucky in that we're going to get not only an update on some of the things that he talked about before, but also we're going to put that in context of the tax season in which we're all in now. And so with that, let me turn it over to Corey. And then as we go through this, you'll note that it is being recorded and we will have the recording available for folks. And we will also do questions at the end, but feel free to put them in the Q&A box as they occur to you as we go throughout the presentation. And with that, let me turn it over to Corey.
Thanks, Ben. It's great to be here. And first, I'd like to say thanks to the IPA for having me. So tax season is always a really busy time for us at Ubiquity. Our digital banking clients face upticks in dispute volume related to tax refund deposits and the spending that goes along with it. But it's also, unfortunately, a time where fraudsters are, kind of taking advantage of that. And we see a lot more sophistication in their attacks. Certainly more damage that's done in a lot of cases, while account takeovers and first-party fraud, or sometimes called friendly fraud, are also on the rise. And there's certainly the macroeconomic environment that's driving things as well. So today we're going to get into a couple of details about what we're seeing and how we're working with our clients to mitigate some of these losses. So before we dive in, I do want to say a couple of words about Ubiquity and where we sit in the value chain. So last spring, we celebrated our 10-year anniversary as a company. I'm one of the founders, together with a couple of other people. And we had been in the industry for about that length of time before starting Ubiquity. So many of us have been in the space for 10 years, working in the managed services space for fintech and financial services providers like TXVia, TSYS, Clarity Payments, and others. What we do as an organization is to provide customer service and back office support to digital banking brands, as well as what we call banking operations. And banking operations for us includes disputes and chargebacks, manual identity verification, fraud reviews, and kind of related activities. So we have well over 3,000 people working full-time in this division on a dedicated basis today. And we see a lot of growth and demand in this space because of the expertise required, together with ongoing staffing challenges that our partners face around the world. We support many IPA members and we're members ourselves. So we're especially appreciative of this forum because we know that the fraudsters are sharing information and we need to do the same. And I would just encourage everyone listening to this webinar. It's ultimately a small space. I would say that, there are a lot of areas where, some of the members of the IPA compete with each other, but I think everyone could agree that fraud hurts the industry. in total, and sharing information around tactics that that we're seeing, I think, only benefits the entire ecosystem. And lastly, I'd say that I'm also eager to hear from you about what you're seeing on the front lines with your customers, both in the Q&A, and I'm always happy to chat with people as well. So you can always feel free to reach out to me. So that's Ubiquity. Now let's talk a little bit about, kind of the environment where we are and what we see with fraud today. It's a growing problem. First, between 2019 and 2021, ACH and debit fraud rose a staggering 531% globally. And that's according to a report from last year coming out of TransUnion. We've seen, we've seen this firsthand in a lot of our portfolios that we support. Account takeover losses were up 90% in 2021. I don't have a number from 2022, but if anything, I would say anecdotally, we've seen that trend continue. Traditional identity theft combined with identity scams, where scammers convince consumers to share personal information, resulted in losses of $52 billion and affected 42 million US adults. So obviously, this is top of mind for Ubiquity and for a lot of our clients. A survey of large US financial institutions reported that their average cost of misuse of digital payments was about $120 million. And finally, the cost for banks to manage fraud has jumped to $4.36 for every dollar of fraud that they actually experience. So people are making more investments than ever in fraud prevention. But unfortunately, fraud rings and bad actors are also putting more resources than ever into kind of successfully pulling off attacks. And we'll talk a little bit more about that in the future slides. But to put this all in perspective, this is a 22% increase from pre-pandemic levels across US and Canadian financial services firms, which is kind of staggering. So let's talk about the kind of downstream impacts that we see. So disputes and chargebacks really are on the rise. Taken together, what all this means for us working in the space is a massive increase in volume. Recent Ethica data estimated that chargebacks would hit 252 million globally in 2022. And again, our expectation would be that will be even higher this year. While banks surveyed on behalf of Ethica attributed a higher percentage of chargebacks to customer confusion, between 10 and 39%, depending on the institution, compared to first-party fraud, about 10% in their survey, more than half said that first-party fraud is growing. And we'll get to it a little bit later in the presentation, but certainly for some of the portfolios that we support, the first-party fraud is much, much higher than 10%. So let's actually talk about the surge in first party or friendly fraud. We're seeing this drive a significant, or at least contribute to a significant increase in dispute volume. And it really does depend on the customer base. So we see that certain types of portfolios experience a lot more friendly fraud than others. Certainly, we see it as a much bigger problem in the debit space than the credit space, of course. But certain types of debit products have a much higher propensity for friendly fraud than others. And given the current economic environment, we're only expecting it to get worse, with consumers facing economic pressures like inflation, and increasingly relying on debt to make ends meet. This means that, with this pressure, certainly we expect an increase in friendly fraud. A 2022 TransUnion report shows that friendly fraud increased by 54% between 2019, so just pre-pandemic, and 2021. And while that's across all industries, financial services certainly sees a great deal of that. Some forecasts even suggest that as many as 6 in 10 chargebacks will be due to friendly fraud. And those trends kind of align with what we see in certain portfolios that we support. So, that's kind of in our view directionally accurate. But again, we recognize and see firsthand that different financial institutions and different product types see fairly substantial differences in this. One of the things we're seeing from cardholders who are trying to game the system is an increase in disputes or disputers that will basically file a claim, spend the provisionally credited funds almost immediately, and then even file a dispute on those transactions as well. So really, it's double dipping. And it's a trend that we're seeing from kind of third-party fraudsters like fraud rings. And we've seen this very frequently in conjunction with tax refund fraud. So kind of the use case there is that there's a stolen deposit, basically, whether identity theft or something else. A fraudster will, work to open or gain access to an account, get a fraudulent tax refund effectively, spend the funds, and then almost immediately dispute those purchases in hopes of being able to effectively get access to the funds twice. And we've also seen coordination in those efforts where fraud rings will sometimes I think, frankly, attempt to overwhelm operational practices and systems by trying to have a large number of disputes, nearly simultaneously in hopes that it'll increase their chances of getting provisional credits. But the good news is that those high velocity of disputes can be a really good red flag to help both identify and shut down fraudulent activity. So it's really, really critical to have real-time analytics as part of the process when thinking about disputes. And we'll talk a little bit more about that later. So let's take a deeper dive into some of the evolving fraud tactics that we're seeing. While we aren't necessarily seeing an uptick in overall fraud per se, we are seeing a much greater sophistication from fraud rings and first-party fraudsters, and the impact or potential impact of their activities seems to be more significant. Fraudulent ATM disputes could be considered kind of a classic scheme and something that's been happening for quite some time, as well as buying, merchandise, kind of large ticket item purchases, things like televisions, laptops, etc., that they could easily sell and try to dispute those purchases. But what we're really seeing today is a lot of added layers of complexity. In the past, a lot of times these were limited to specific geographic areas, but we see that today fraud ring networks are getting more diverse and quite frankly, sophisticated. So they're often not just targeting one geographic area, so they're better at spreading out their network. We're also seeing that fraud rings are seemingly stealing cards from mailboxes, and then activating them and filing a lot of disputes. And this is something that's happened over time, but we're seeing more of this type of activity. And again, it's activity that's not just concentrated to a few block area where they're operating, but they're getting more sophisticated about spreading this sort of thing out. And even as account takeovers happen, we're seeing more sophistication there too, where instead of having all of the accounts that have been taken over, with the attempt of getting cards reissued sent to a few different addresses, they've really spread that out. And seemingly kind of understanding when the card is likely to arrive and trying to steal them from different mailboxes that are unsecured. So the operational element overall, I'll say, is a lot more refined than it was in the past. We're also seeing fraud rings, kind of getting a good sense of provisional credit parameters that might be in use, where they get a sense of when when a financial institution is likely to automatically issue credit on certain types of claims. So one of the things that they try to do is kind of either via social media or other means, incent cardholders to kind of give up accounts that maybe they've decided to stop using recently, filing claims or disputes really on old transactions, and then working to get access to that account. So that's certainly something that we've seen. And all of this has kind of culminated for a lot of our portfolios in millions and millions of extra dollars in disputes over kind of what the trend based on spending would support. On the first party fraud or friendly fraud side, we're seeing a lot more discussion on social media that's giving people tips on how to abuse the dispute process. So the situation there is really legitimate cardholders are using what I'll call really obvious form letters that are copied from online sources to file their claims. And we can see this across a portfolio, and sometimes the same template used across multiple portfolios. The good news here, though, is that we are working closely with our clients to get better at quickly identifying this type of activity, and then working together to try to shut it down. Let's talk in a little bit more detail, though, about 4 big areas where we're seeing a bit of an evolution here. So first, with phishing and account takeover. So this is always a big growth area during tax season. The kind of incentive for fraud rings is often higher. If they can steal an identity, open an account, and get a fraudulent tax refund, the potential benefit to them is huge. Just this month, NerdWallet published a list of 14 different ways scammers are posing as the IRS and other government agencies to either trick or scare consumers out of data that would allow them to kind of participate in this activity. And they reach out with things like, hey, we recalculated your tax refund, just fill out this form and you'll get a bigger refund, or you're owed money. Or threats like, we'll cancel your social security number if you don't fill out this form, or they'll use a form that looks like a legitimate IRS form to try to entice people to give up personal data. And we've seen scammers posting ads on social media, posing as tax preparers to get consumer data, often for free, and then filing a fraudulent return on someone's behalf. And like I talked about earlier, kind of double dipping by then trying to dispute a lot of those transactions. And one of the things that we're also seeing, kind of in conjunction with this, or maybe a few of the red flags, if you will, are things like deposits not under the customer's name where the tax refund is deposited. That's an obvious one. But also, leading up to this activity, especially with accounts that are taken over, excessive changes to account information. And here too, fraud rings have often gotten more sophisticated in testing and really kind of probing processes to understand, what anti-account takeover measures might be in place on a particular portfolio. So we'll see, cases where, they'll kind of probe and understand that, like, okay, well, if you've changed an address and requested a card to be sent out, that's the sort of thing that for most portfolios would, trigger a response, right? This looks like an account takeover, but often there's going to be a period of time associated with that. Maybe it's 30 days, maybe it's 15, maybe it's 60. They'll kind of probe and test and find out where that threshold is. And we've seen instances where, let's say the threshold is 30 days, we'll have a lot of, address changes. And then exactly, 31 days later, there'll suddenly be, requests for replacement cards, that sort of thing. So, there's a lot of, again, sophistication that's going into understanding what counter fraud processes are in place, which makes it very important to, again, be understanding what kind of activity is happening across the portfolio in a very real-time way. We're also seeing, as kind of a typical indicator, and especially given what we talked about in terms of fraud rings trying to use phishing tactics to get information to open accounts, a newly activated account where the initial source of funding really is a tax refund, and then and almost immediately the consumer will dispute all, or most, if not all, of the transactions. Again, a really strong indicator that that kind of fits within fraud ring activity. And then that also, I would say there's things you can do in terms of handling those particular disputes to try to limit further exposure. But I would say the bigger picture there is, as soon as you've identified that there is an apparent fraud ring activity kind of in play, look at what are the indicators there. What are the IP addresses that were used, for example? Are there any other accounts that happen to have the same phone number, email address, address? Fraud rings are getting more sophisticated, so they also understand that reusing the same contact details is a red flag. But nonetheless, we still see a lot of that, and that can be a good indicator that that there are other accounts that are about to be targeted, and that you might be able to take proactive action on. The other, another thing that we see a lot of and is worth looking at is, we see that the funding source of a tax refund might, on the state level, might come from a different state than where the cardholder resides. That in and of itself is not necessarily an indicator of fraud, but it is something kind of worth looking at to understand whether that is or isn't legitimate activity. So that's kind of one tactic. The next tactic that I'd like to talk about is ATM withdrawals and disputes related to those. So ATM cash not dispense claims are really a favorite for both third-party and first-party fraudsters. I mentioned double dipping earlier, and that's becoming more prevalent with ATM transaction disputes as well. So for the non-dispense claims, we've traditionally had really good luck reaching out to the acquirer, the ATM operator, to determine whether the machine was out of balance or not, and either approving or denying the claim, kind of based on that information. Most of the time we can get a response quickly. But if we can't, I would say that in most cases, if you file a chargeback on an ATM non-dispense claim, the operator will provide a response before the provisional credit deadline. So it's so, kind of both easy, but we've seen a lot of portfolios, where this could get missed. It's easy to basically say, great, ATM non-dispense claims should either be getting a response through a relationship developed with an ATM operator, or should be getting a chargeback on the same day that it comes in. That's really going to help, lessen the exposure on those types of claims. That said, we have noticed a delay in receiving a response, on some of these from certain ATM operators. And so, it's very essential to process the chargebacks as soon as practically possible and work to build relationships with ATM operators, and especially operators where there are unusual levels of apparently fraudulent claims. We've seen certain instances where it appears that there might have even been, a certain amount of collusion between a fraud ring and perhaps someone embedded within an ATM operator, and therefore it's important, I would say, to kind of be aware of these trends and be fast about identifying and escalating them. We've seen good responses by doing so. And in this area, friendly fraud can be really difficult to prove because the cardholders kind of know how to work the system and are sharing their tactics for taking advantage of consumer protections like Reg E and Reg Z, to get provisional credits. And one of the reasons why, this claim is so popular is that you can get the provisional credit and still have use of your card, right? If you're claiming it's fraud, often a card replacement is going to be a part of the process, which is particularly a problem for a fraud ring. But even for friendly fraud, introduces a certain amount of friction to the process. So if you were going to commit first-party fraud, this can be a quick way to get cash. You get the cash from the ATM machine, and if you get the provisional credit, you've gotten double use of those funds until it eventually gets reversed, and presumably then the account has a negative balance, which is impossible to collect. We have seen our clients, cardholders, kind of active in social media, offering tips on, how to make, basically, as it's called, quick cash. And again, this goes back to where some of those form letters and templates are in use. The knowledge that's out there today and kind of consumer knowledge of regulations is really pretty detailed. And in fact, we've even seen what we can identify as obvious first-party fraudsters kind of making regulatory complaints if they feel that something wasn't handled according to the regulation. So there's a lot more knowledge and even a brazenness that comes with it. Another tactic that I'd like to talk about is P2P transfers. And one thing in particular that we've seen a real uptick in here is, through various kind of P2P payment apps, that the cardholder will initiate a small transaction for, say, $1 or an amount like that. And then eventually there's some force post transactions for higher amounts. And then that'll drive an account into a negative balance. So we've seen a fair amount of that across multiple portfolios. I would also say that another thing to kind of look out for is we've gotten a lot of first-party fraud disputes related to P2P transactions where the consumer will claim that they were going to pay someone, but they ended up paying by other means. So, there's kind of a lot of that activity. And we've had some success in developing closer relationships with some of the P2P transfer operators. The last tactic that I'd like to talk about here is really the online education and recruitment angle. So we've talked a bit about this, but on the friendly fraud side, we're seeing a lot more discussion in a lot more detail. We're seeing things like templates, and it's blatant, and this isn't a dark web thing. This is something that you could go on popular social media sites and find quite a lot of discussion on. And legitimate cardholders are really getting just a lot more education, and this is driving a lot more of this activity. There are remarkable similarities from one customer to another, using the same kind of form letter. Maybe hundreds of customers might use that same form letter. We've even seen instances where, let's say some of our clients have multiple portfolios where, the same cardholder will have accounts, kind of across multiple portfolios that are kind of a part of the same operation. And you'll see the person actually go from portfolio to portfolio using the same letters, the same tactics, and indeed even kind of across clients. Obviously, sharing details of specific cardholders is something that we're not able to do, but we are able to share some of the commonalities, and that's something that we're really focused on. Another trend that's not quite as common, but can be really costly potentially, both just from an investigation side and certainly losses if provisional credits get issued, is we have seen activity where fraud rings are basically working to try to buy dormant accounts. I'll give you a gift card if you give me your account details of, an account that you don't use anymore. And from a consumer perspective, they think, okay, well, I'm not planning to use this account anymore. It doesn't have a balance. I get a gift card out of it, whatever the amount. Nothing lost. And then what will happen is the fraudster will often try to dispute a lot of old transactions. It really costs them very little to do it. They still have to get access to the account, which might include changing the address and requesting a new card, or depending on the portfolio, maybe a mobile wallet provisioning. There could be different avenues that they attempt. But certainly this is something that we've seen on a couple of portfolios. It's not as widespread, but it is something that's becoming a little more prevalent and costly to address. So, this is an area where disputes and risk management, it kind of crosses boundaries a little bit, need to be communicating and sharing data within the organization really effectively to make sure that, these kinds of things are addressed. So let's talk now a little bit about some specific strategies to mitigate losses. What can you do to stem the tide? Obviously, preventing fraud is a lot more effective than dealing with it on the back end. However, with the dispute process being abused by cardholders and criminal fraudsters, mitigating losses while protecting legitimate consumers is really critical. So we should never forget about that, right? There are a lot of legitimate consumers that have actual account takeovers and fraud issues, and the customer experience element is something that we shouldn't forget about. So from where we sit in the process, we collaborate really closely with our clients to make recommendations, but it's really ultimately up to our client and their compliance team and their issuing bank's compliance team to sign off on any significant process changes. And while I can't speak to any client specifics here, I can talk about a couple of general best practices to keep in mind. I would also just provide a quick disclaimer that I'm not a lawyer and not in a position to provide legal or compliance advice. We always tell our clients certainly that we'll try to give the best advice we can, but like I said, it's really important that your respective legal and compliance teams are obviously reviewing kind of all significant changes to ensure that it aligns with your view of the regulation. So what are the strategies? First, I would say speeding up the process, trying to finalize claims within 2 or 3 days, if possible. Accelerating the investigation and resolution process does a couple of things. It helps with some of the customer experience issues that are naturally a part of the dispute process, but it also helps to prevent some losses on provisional credits. If you effectively determine that you're going to need a chargeback in order to pursue a case, you might as well do that on day 0, the day that the claim is filed. If you've waited a few days, you've lost an opportunity there. In addition to, fending off fraudsters and abusers, speeding things up also, like I said, improves the customer experience. It's definitely helped our clients, many of whom consistently rank very high in Net Promoter Scores and customer satisfaction, including within the dispute process. So this is often a driver of consumer complaints, or if not actual complaints, just kind of poor customer satisfaction. And with a number of partners, we've been able to meaningfully improve Net Promoter Scores and customer satisfaction while, mitigating losses on the provisional credit side. Speed, though, can increase the possibility for compliance and other errors, right? So you have to move smarter. That means that segmenting your teams by claim type and risk profile is a really good best practice. We found that certain claim types, for example, ATM non-dispense, which you'll almost always want to handle in a specific way, P2P payments, which have unique challenges, unauthorized transactions versus error allegations, and so forth, and also risk profile, like the dollar value of a transaction. And having one investigator then handle a claim from start to finish is a good way to boost productivity and compliance. In fact, for some clients, we've reduced overall headcount because of productivity gains associated with that kind of specialization, while at the same time reducing losses and errors. But you do need to be certain that you apply your segmentation across the board rather than at the customer level, which could otherwise violate UDAP rules, right? So in other words, you don't want to, have a different set of rules by particular customers that you might see as higher risk. I would also say that where you can use technology to help automate workflows and minimize the potential for human error, definitely do so. Artificial intelligence is something that, as an organization, we've invested in a number of areas of our company, and we think it can play an important role in dispute management. However, we don't recommend using AI for claim decisions. It could actually create more problems than you end up solving. Regulators pay very close attention to the dispute resolution process and especially decisioning. And the fundamental challenge is that if you have an algorithm that you can't explain why it made a decision for a specific claim, you're not going to be able to explain that to a regulator. And you can't go back to a regulator and say, well, I've got this AI model that said we should deny the claim. I can't tell you why, but that's what we did, right? So what we do is we see AI as a helpful tool in guiding agents to the right decisions, as well as serving as a kind of double check on claim decisions. But the investigator really should be the one making the final call with proof points to back it up. A couple of examples there. So, I think looking at something like GPT-3, which is the model that ChatGPT was built on top of, that's been in the news a lot lately, makes an excellent basis for an agent-facing artificial intelligence assistant. And that's something that I think has been successfully deployed and is worth considering. I would also say that building machine learning models based on kind of historical data to understand whether a particular transaction seems to be first-party fraud, for example, is a good idea. You don't necessarily want to use that model to automatically decision cases, but if an investigator decisions a case differently from what the model would predict, then that might be a good candidate for a case that you'd like to have a sort of a quality assurance check on, let's say, before action is taken or something like that. The third strategy, I guess, that I'd like to mention is the importance of establishing a fraud review team within the disputes operation. So depending on your dispute volume and fraud losses and size of portfolio and other elements, one option would really be to set up a specialized fraud review team within the dispute operation that's really proactively monitoring and analyzing data to identify patterns of suspicious or suspected fraudulent activity. It's essential to look for patterns, for example, by merchant, by claim type, by geography, that it shifted, and seek to understand them on a daily basis. Having a better understanding of how dispute trends are changing over time in real time gives you a great framework, not only for responding to fraud, but also ensuring that the team is adequately resourced and organized. It's also important to train investigators on how to identify and escalate unusual activity. A really basic example of a red flag that our investigators are trained to look for is claims on connected accounts. So, for example, sometimes you do have, several or dozens of accounts that appear to have different cardholders, but the same phone number, the same address, that sort of thing. And being able to escalate those claims to our fraud review team has helped us to identify and really help our clients shut down the activity, ideally before a provisional credit is issued and a loss is taken. Once the team that's working to identify trends is in place, you can also build investigative teams that specialize in certain areas. For example, if you know a lot of friendly fraud or fraud ring activity occurs on your portfolio around tax refund season, training teams that specialize in those types of claims is both more efficient because you can train agents more quickly, but because of that specialization, you tend to get higher quality out of them as well. So it makes your team a lot more elastic and a lot more able to respond to trends quickly. I would say that, as a service provider, we don't deny claims when we identify a potential fraud scheme, but instead we work with our clients to provide recommendations so that they're able to review the data, review the facts, and we work together and partner to decide how to move forward. But we do this quickly, keeping in mind that a provisional credit window is there, and fraud losses will continue to mount. So thanks to our tenured fraud and disputes experts, we've been able to identify fraud ring activity and stop further abuse of the process, saving millions of dollars for our clients in the process. The fourth thing that I would call out is the importance of arming frontline staff with knowledge and making sure that they know what to do with it. So the communication flow for us is not just going upstream to our clients. It's imperative that we're regularly training and really retraining our frontline staff with what's going on in fraud, sitting down with people and ensuring that a dispute investigator understands the why behind what they're doing, and they're constantly asking, why am I making this decision? Why are customers behaving in a certain way? What are the red flags that we've already identified? Regardless of the size of the team, your dispute and risk operation need to stay in close contact with each other, and mining that information from the dispute team is essential. Being able to identify new trends or patterns and then organize your dispute operation around that is a best practice that I would encourage everyone to adopt. And then lastly, I would say investing in better forecasting is really important. So when you compress the investigation time, like I talked about, volume forecasts certainly can't be monthly or weekly. Even daily is not, ideal. You would want to have an hourly understanding how many disputes are coming in. If we're trying to decision cases on day 0 and potentially pursue chargebacks, you need to treat dispute cases a little bit more like you would a phone call or an email or a chat interaction. And historical data should be used to create a baseline forecasting model. Higher transaction activity almost always precedes higher dispute activity, so that's one factor to look at. But other things like tax, refunds and holiday spending, et cetera, are predictable things that should be taken into consideration. So we've talked about a couple of specific strategies. Now let's talk a little bit about customers quickly. Don't forget about the customer, right? We've talked a lot about, first-party fraud and abuse of consumer protections, but we have to remember that there are a lot of legitimate customers that get caught up in the process. Nearly half of American adults have had a fraudulent charge on their credit or debit cards. That's 127 million people. More than 1 in 3 credit or debit card holders have experienced card fraud more than once. And so, that's a reality. And we're also seeing that consumers are getting kind of inundated with manipulative texts and calls and emails claiming to be from their banks. 72% report feeling that way. Another 57% note that they've received phishing links and emails and fake fraud alerts and notifications through malware apps and that sort of thing. And taken in total, it can be easy to forget that consumers, are kind of the victims in this process in a lot of cases too. And so, keeping the customer experience front of mind remains essential. The number one reason that customers will stop using a financial service provider is having a bad experience. And we know that one of the biggest drivers of dissatisfaction among customers is the dispute process if it's not handled well. So, what do customers want? Really, at this point, they demand trust, honesty, and data privacy from their financial services provider. That means if something's gone wrong and they're dealing with suspected fraud or other errors, how you respond is going to make a huge difference in how the consumer looks at your organization. They need empathy and expertise to guide them through the process in a compassionate yet clear-headed way. Money is emotional for people, right? And so, for a legitimate consumer who suddenly has, lost a substantial amount of money from their account, that is going to be an emotionally draining experience. And that empathy and compassion is really, really important. it's important to also engage customers in security awareness before something goes wrong, right? Raising awareness about scams, phishing, account takeover risks is something that, is a good weapon against fraud. And I would say that if you're operating a portfolio and you find that there are, kind of specific emerging patterns, work with your marketing department as part of a consumer education campaign. As the fraudsters adapt, we must also, right? So in conclusion, I hope you've gotten something out of this discussion or perhaps confirmed what you're already seeing in your own portfolios. If there are any questions, I'd love to take those at this time.
So Corey, thanks for that presentation. We do have a couple of questions here in the Q&A, and I've got a few as well. There's a question: do we provide a transcript, email confirmation of training completed? So this is not a formal training program, so we won't be doing any of that. But as far as a copy of the presentation, Ubiquity will provide an email, I believe, in the chat, and people can request the slide deck and the sources for some of the things that were, some of the stats mentioned. If you guys want to do that, you'll see Lorraine has put her email in the chat, and I encourage you all to follow up for that deck. I wanted to ask a couple of questions, if I could, as we kind of before we wrap up. And one thing that you talked about was account takeovers being up in 2021. And I was wondering if that's kind of a continuation of some of the things that we saw kind of growing out of the pandemic. And do you think that'll slow down? Or is it something where it's a lot of things were compromised during the pandemic and we're going to see a continuation of that trend?
It's a great question. Look, I don't have a definitive answer here, and I don't think anyone does. But what I would say is that, we didn't talk about it in this forum because it's a past thing, but we saw a lot of fraud activity. I mean, really, there was a lot of fraud activity around PPP and those sorts of things. And one of the things that we suspect is that fraud rings effectively built out organizations that increasingly look more and more like businesses. They have more resources than ever. They built out teams of smart people who are funded. And as that stream of money kind of dried up, they've tried to take those resources, I think, and apply them against other other opportunities to commit fraud. So I don't have definitive, evidence of that, but I would say that, everything I've kind of heard in my sense is that there was a huge jump in sophistication that happened during the pandemic, and this is a continuation of that.
And do you have a sense from, and recognizing, right, that there's only so much that you can reveal, but do you have a sense of how much the balance of the total fraud that you're seeing is friendly versus third party?
Yeah, so I would say that friendly fraud for most portfolios makes up more than third-party fraud. I don't have an exact percentage off the top of my mind. And again, certainly some portfolios see an awful lot more friendly fraud than others, to be sure. But for many of our portfolios, friendly fraud is the single biggest driver, and often more than 50% of fraud claims.
And do you think that's just people are stressed and trying their luck, or have they, to your point, what you said in the presentation, they've gotten better at kind of recognizing, like, here are ways that I can kind of play games with the system?
I think it's some of both. I mean, there's definitely more stress, financial stress today for the average customer than there was 6 months ago, than there was a year ago in a lot of cases. So that's certainly part of it. But the amount of online education that we're seeing really is unprecedented. And again, like I said, I mean, you can follow the same templated letter from one portfolio to another, from one customer to another. So it's clear that these, education campaigns, if you will, are having a real impact.
And I wanted to pick up on something that you said that I thought was really important about AI. And you said that essentially, right, I can't, as a service provider, just kind of hide behind my AI if I deny a claim or something like that. And I know the CFPB has expressly said you can't hide your decisions behind AI. Are there other tools that people can use? Like, I think about that templated letter, right? And is there sort of machine learning or something else where people can say, look, we have a tool that reviewed this, we can spot these different things, we knew that this was something we had to follow up, that kind of thing. And if I am a company using AI, right, and you said, look, this should go to a person, is it important to kind of document the process that the human might use to approve or reject a claim?
Yeah, that's a great question, and probably the best question of all, I would say. I think that in a lot of ways, the thing that people should be doing isn't even necessarily as complicated as using AI. We've worked with a lot of clients that, as they kind of come to us, haven't necessarily thought through the basics, things like documenting processes completely, thinking about how do we train our investigators and make things repeatable? How do we have continuing education for them? On the system side, I would say that more impactful in a lot of ways than AI on quality of decisioning would be bringing together all of the data that an investigator might need to investigate a claim and make a decision into one place. We have some portfolios we support where agents have a dozen different systems that they need to go to locate pieces of disparate data, and they're trying to pull this together in one picture that's both not very efficient, and also is something that doesn't lend itself to analysis. Once you've got everything together in one system, that's where I think you can layer on AI, maybe not to decision, but to point agents in a certain direction, to highlight pieces of information that appear to be relevant, to assign kind of a risk score to different factors to decide, how do I route cases? You're going to know that some investigators are better than others. If you have a small portfolio and 3 people handle all your disputes, that's one thing. But for a lot of our clients, that number is 100 or 300 or 1,000. And at that kind of scale, you're naturally going to have people that have certain strengths. And there too, you can use technology to kind of route cases based on, risk factors, to investigators that are going to be your strongest, as an example. So a lot of things you can do, but I feel like before you can even get to the point where you're thinking about how AI might come into play, you have to kind of get the basics right. And quite frankly, even being familiar, some of the biggest banks in the world haven't actually solved that first fundamental need.
Yeah. So we did get another question from the audience, and for third-party fraud during the pandemic, there was an increase in foreign-based actors. Is that something that is continuing, and is that part of that sophistication that you were talking about, that people have figured out, hey, we can do this?
Yeah, so we've seen an increase in it, but I would also say that it's a little bit easier to shut that down for a lot of portfolios. So in the sense that, it depends on how much activity on a portfolio would be expected to be, kind of foreign transaction activity. How many people would be traveling? And therefore, does it make sense to try to lock down access from outside, the US or, certain countries? So while, yes, we saw an increase in it, I think what we've seen is that a lot of our partners have been able to kind of use intelligent, fraud controls to shut down a lot of those activities. It's a lot harder to do the same thing with fraud rings that are operating in the same communities where the legitimate customers actually live, right?
Okay, are there any other questions here before we wrap up? I put an email in the chat for requesting a copy of the deck. And if there are no further questions, let me say thank you again to Corey and to the Ubiquity team for presenting today. We appreciate it. And there will be a copy of this posted, and be on the lookout also for a podcast version of it. But again, thank you to Corey for sharing the information and giving us all a little bit of help in figuring out how to deal with a problem that is becoming increasingly complex and against actors who are increasingly sophisticated.
Thanks, Ben.
Thanks, everyone.